Now, to kick things off for our fantastic speaker lineup for today's SPACS virtual event, I'd like to welcome our first presenter of the day, Mark Solovey, the co-president of MCAP Acquisition Corp and managing director of Monroe Capital. Mark is going to be joined by Roger Aguinaldo, the CEO of M&A Advisor, for a one-to-one chat discussing SPAC fundamentals and the life cycle execution. Mark and Roger, why don't the two of you go ahead and get started on this engaging conversation?
Thank you, and thanks for having me today.
Thanks, Amanda. Hey, Mark, how are you?
I'm good, Roger. How are you?
Okay, terrific. Well, listen, I just presented a really, bad viewpoint on SPACs, right? I guess, and the reason for that is, there are sellers and a lot of private equity and a lot of people who, with the run up in SPACs are saying, well, this is a flash in the pan. SPACs are really, it's not really a good way to go public. There's a lot of, disadvantages of it, notwithstanding the 20% promote, which is, obviously very expensive, versus the private equity 2 and 20% of the profits. In a SPAC, you get 20% of the stock, right? You're basically getting all of the capital. It's as if you raise, let's call it $100 million, and you're paying that sponsor a 20% transaction fee, right? But so let's see how and why your company has been very successful, Mark. Tell us a little bit about some of the SPACs that you've raised and why Monroe Capital found this to be very attractive.
Thanks, Roger. So I've been involved with SPACs for 15 years or so. So we're not new to the SPAC industry. The SPAC market has changed a lot in those 15 years, and the quality of companies and the quality of SPAC sponsors that have been involved with them has changed a lot, particularly since 15 years ago when it was the second generations of SPACs. But in this new generation, which has become...
So you were involved when SPACs was certainly a 4-letter word.
It was more of a retail business, and it was much less understood and accepted by the market. The rules were very different back then in terms of SPACs and whether you could vote for the SPAC or redeem your shares. There was a much smaller group of hedge fund investors that were involved, and it wasn't accepted or really well known by the broader markets. And because of that, 15 years ago, you didn't have the same quality of companies that would consider the SPAC market, which is what is going on today. So it's just that, it was called a SPAC, and it was a similar concept that you had capital raised in an IPO, and it went into trust, and you went to buy a company with that. But it was a different group of people in the ecosystem back then.
Yeah, your recent SPACs are different, though, right? Your recent SPACs through Monroe Capital, Thunderbridge 1 and 2. Tell us about those.
So we got involved at Monroe Capital as a co-sponsor about 3 years ago with Thunderbridge 1. And that was, I would call it the beginning stages of the new generations of SPACs. And it still wasn't particularly well understood back then, but the model was different. And you even showed that in your chart of how much capital was raised, 3 years ago, 2 years ago, 1 year ago. But, we had a concept that we wanted to create a quality SPAC product, an institutional quality SPAC product, find an institutional quality company and go out into the marketplace. And so we co-sponsored the Thunderbridge SPAC, which was focused on a fintech company, fintech acquisition. And we ended up completing a business combination with a company called Repay. Repay was in the fintech space. It was a payments business focused on lending companies. And it was a deal that we knew particularly well at Monroe Capital because we had financed the LBO acquisition on that deal prior to the SPAC. So Monroe Capital, just to take a step back, is a boutique asset management firm based in Chicago. We have AUMs of over $10 billion today, And we spend a lot of time at Monroe Capital focused on lending to high quality companies. Many of them are with private equity firms, and some are with founder-owned businesses. So Repay was a deal that we had financed out of our credit side in conjunction with an acquisition by a private equity firm. So we know that model very well. And after we completed our IPO for Thunderbridge One, we then were able to cut a deal with Repay to complete that business combination. So, but back then again, it wasn't. It was still a newer concept, even though a different generations of SPACs. So we had to spend a lot of time educating the investment banking community, educating the investor community, educating all the parties that are part of the ecosystem, all the third parties that were involved, because they just hadn't seen SPACs for a long time. It was just beginning. So it was very, very interesting, different type of process back then.
Yeah, Mark, let's dive into that a little bit. I suspect many of the people on watching the webinar are facing probably the same challenges you really faced only a couple of years ago. It feels like a long time ago, right? But it's really not, right? And by the way, Repay is now I think trading at almost 230% at 230% return. Oh, so congratulations on a very successful SPAC, DSPAC, and really what you want to do, right, is have an operating company that's public that trades very well. So that is very hard to do, obviously, in this with so many SPACs out there. So how did you convince the seller to go this direction? What were the other alternatives? I would imagine, and maybe answered in the context that there are SPAC sponsors currently watching the program. There are sellers looking at this as well. So how would you help them out?
Well, the SPAC sellers, the companies, Repay, any company that's considering a SPAC typically is going to have an investment banker involved in the process. And often they're considering several different paths. They're considering a sale to a private equity firm, they're considering an IPO, or they're considering a business combination with a SPAC sponsor. So one of the key attributes I believe that comes into the mind of a company when they're talking to a SPAC is the certainty to close. It's the same question that we get when people are comparing what private credit firms to go with, or a private equity firm is looking who's going to provide that capital. And so I think valuation is part of it, certainty to close is part of it. What can the sponsor do? What can it provide? That's going to be value add. I mean, you pointed out some of the, some of what the sponsor is getting, but there should be a question from the company. What are you giving to that company, and where do you come in? So Monroe, now we were a co-sponsor of Thunderbridge, but we were, very involved with it. And we're a substantial financial organization with all that AUM. And so we have a lot of sophistication and a lot of experience and, pockets of capital to help in the process. So I think as we were talking to the team at Repay, which again, we knew because we helped them finance their previous deal. We helped the private equity firm make that LBO acquisition of them. We talked about all the different aspects of what we had available to help them out in the deal, and why we felt we could provide them certainty of close, that the deal that we were offering was the deal that was actually going to be closed upon. And so I think that was important. It was important for us to also get the confidence of the management team, confidence of the shareholders, confidence of the private equity firm behind it. So there's a lot of parties that we gave confidence to.
Yeah, it sounds like certainly the sponsorship, or who's sponsoring the SPAC, is extremely important. But it seems that you had a strong relationship with the folks at Repay.
We did, which was beneficial because we had effectively already started our diligence on the company before we were doing a deal with them. It was in our portfolio for several years. So we weren't coming to the market, coming to them and saying, hey, okay, sounds interesting. We had an hour-long management presentation. Let's do a deal. We said, we've been involved with you guys for years. We know everything about, we know a lot about this business. So we're not going to find any surprises when we do our diligence. And that's, one thing that anybody has to look at in an M&A process or a SPAC process, that your sponsor is going to do deep diligence on the company after you sign an agreement to do that. And so you're relying as a company on the fact that the sponsor really knows what they're getting into beforehand. Because if they don't, and they sign a deal with the company, they start to do the diligence and they say, well, we don't really know that. We don't know that. It gets to be an uncomfortable situation. So we did not have that with Repay.
Yeah, no, that's interesting. And I would, you see some private equity thinking about starting their own SPACs. There are some large mid-market private equity and many large private equity like Apollo who are raising their own SPACs. But you're coming from the private debt side. Do you see, maybe the market evolving towards perhaps private debt, going into the SPACs more so than the private equity?
Well, you need to put your equity hat on when you're doing a SPAC. And so I think it depends on the team of people that are involved at really the operating level of the SPAC. So it's going to depend. Do they have equity experience? Have they done deals? So that's going to be important. And then it's the experience level of the team. Again, I had been involved with SPACs for a long time, and so I was able to put that hat on and put that perspective on. There may be other private credit. There certainly are other private credit firms that do it, but it seems to be more predominant in private equity firms because they are typically looking for companies to acquire. And so that's already part of their DNA. From a private credit firm, it's not a typical part of their DNA. So you're probably going to see less groups that feel comfortable getting into the market.
Right. When you first went into SPACs, or when Monroe's first went into SPACs, you partnered with, I guess, operators, right? In Thunder Bridge 1 and 2.
Correct.
Your most recent ones, you're going it alone, or you feel you have enough experience to be able to have your own SPACs.
Yes, I mean that's correct. This really relies, MCAP relies on the Monroe Capital team, and because we have 500 different companies in the portfolio, we've made a lot of investments. We're looking at it from a financial sponsorship perspective with that asset management hat on it. It's a little bit different, I would say, than the initial Thunder Bridge theme where there was an operator in there. But we have so much data and information at Monroe and history of investing that we believe that is very important for us to be able to be helpful, perhaps different helpful than an operator in it, but still very helpful.
Yeah. No, that's terrific. I encourage questions for Mark, in the Q&A, and we'll be addressing them that are directly related to our topic with him. So please, put them in. Let's talk a little bit about some of the types of companies that perhaps lend themselves better as a candidate for SPACs. Some of them may not be public ready, and do they still should the SPAC sponsors, or even a company that is looking to to exit to a SPAC or go public. I mean, it's the dream of every sort of entrepreneur and owner to go public, but sometimes they're not ready. So talk a little bit about the types of companies that SPAC sponsors should be looking at, and what kind of and what the sellers should be thinking about as they explore conversations with SPAC sponsors.
Well, you really need to be public ready if you're gonna go public through a SPAC or complete a business combination with a SPAC, because once that combination happens, you are a public company, and you're going to be evaluated by the analysts, the investor community, the hedge fund, the whole ecosystem, as if you will be a public company. So one is financial performance. Some of the SPACs will put out, projections or guidance on where they're going to be, just like any public company. And so I think you need to have good visibility into what you are providing. That's particularly important. Two, you have to be prepared for lots and lots of meetings that go on, particularly if you're looking to do a pipe transaction as part of the business. When you're going out and if you're a company and you're trying to find that perfect SPAC sponsor, your investment banker is going to guide you. You're going to do lots of different presentations with different SPACs, especially today with I think you said 400 different SPACs are out there looking for a deal. So you're going to go through that process, and then that's probably more typical of a private equity sell side process than anything else. But then you're going to go, if you want, through the pipe process where the CEO, the CFO, the management team is going to present to, multiple different hedge fund investors who are the typical investors into the pipes. And they're going to be asked all the same questions they would be asked if they were a public company. So that's just very, very important to know that. And then you're going to be comped. There's people are going to ask you, what are your comparable companies? How do you perform to them? So there's a lot. And there's costs involved with that too. So it's very important to make sure you're ready. It's not something to say, oh, market looks good, I want to be a public company, I'm just going to do a SPAC like that. It's not that easy.
Yeah. It sounds very complicated. You are going public.
You are going public. I think that the difference is there's more certainty on valuation because you've struck that business combination agreement with the SPAC, and so that price versus in an IPO, you're going to be pricing the day before, so there is some uncertainty there in a regular way IPO. And the other aspects that I think have driven people into the SPAC market is there's more of an ability to talk about future projections than there have been in the traditional IPO path. And so that's driven people as well into the companies into this market.
Yeah. We have a few questions. I'm gonna jump right into some of the Q&A that and like to get your perspective to some of this. We talked about repay. How do post-SPAC merger companies compare to post-IPO performance in general? You have any thought on that? I mean, I don't know if your firm does any statistical analysis on all that. Any thoughts on that?
I don't have numbers on that. I haven't done that analysis, but I would tell you, I think it's going to depend on the company. I guess you can look at it. You could do that work, but it's going to be company perspective. Yeah,
I would see that. Wait, just for the person who submitted that question, there are the analytics companies. I mean, we use, I think, a SPAC Insider or SPAC Analytics, and they track some of these things. Here's a question: given that the number of SPACs and the amount that that are looking sounds like a seller's market has developed, and purchase multiples will significantly increase. Given this circumstances, address the economic circumstances and future return regarding liquidation. What are the alternative options to deal with these circumstances?
There's a lot in that question, but let me try to answer the part.
I just throw it all at you.
Yeah, no, that's good. If I don't answer all, you can jump in here. a seller's market. There are a lot of SPACs out there, and as they're set up, if they can't find a deal within whatever the period of time is for that SPAC, typically 24 months, then they get in a position that they can return they need to return the money to the IPO investors, or they can ask for an extension on it. And so people think that as SPACs get deeper into that history, get closer to that 24 months, there's going to be they're going to be willing to do something different than they would at the beginning of the SPAC history. It may or may not be true, because there's a lot of risk capital tied up in these things, and just because a SPAC says I'm going to buy a company for a value that is higher than market, I think that's implied in the question, meaning there's so much supply of capital out there that these SPACs, the theory is that then SPACs would pay more for a company than their market. Well, if you are doing a SPAC that has a pipe connected with it, you have to then take that deal that you have come to an agreement with the company, the valuation, and then go out to the pipe market. And the pipe market, like I said earlier, many times it's hedge fund investors. And so if a SPAC says, okay, well, this company I think is worth $1 billion, but I really need to get it, I really need to do a deal, so I'm going to offer $2 billion. Well, let's say that happens, and the company says, okay, we're going to do that. You're the highest bidder. You're Mr. SPAC, like close to the end of your 2-year life. So, I guess you're desperate. There's a lot of capital in the marketplace. I'll take the $2 billion. Okay, well, then you have to go, if you want to do a pipe, you got to go to the hedge fund market. And the hedge fund market's sophisticated. They're gonna know how much time you had left in your SPAC. They're gonna know how the market comps are trending and trading and how you compare to that. And if they think that you've overpaid, the SPAC and the company have agreed to a combination where the valuation is too high, even though they were able to sign up the deal, they're not going to invest in it. And so you're going to end up in a situation where you're going to have to do something different. Again, that's really the situation where a pipe is involved and you're bringing in a third party investor.
Yeah,
so I think that
sounds like though, Mark, you want to triangulate with that pipe investor somehow, right? And that's why the investment bankers who supposedly have a pulse on where the marketplace is important, right?
I mean, it's theoretically an efficient market. And so, yeah, the investment bankers should know the comps at the end of the day. I mean, there's certainly companies that don't comp well to other companies out there, and there's things that, you have a hard time figuring out the enterprise value, but your investment banker should theoretically be a good guide to figuring out the price in the market.
Yeah, okay. I hope that answers the question, Stephen. I knew you threw in another question. So let's go on to the next one. How important, and this goes back to the repay example that you had, how important is pre-existing knowledge of the company for the sponsor? What proportion of the companies are known at the time of the SPAC listing? I guess you don't really, wouldn't have that analysis, but I think it was important that you, at least for your repay deal, that you had that relationship. What about your other deals? Did you have that, relationship, that pre-existing knowledge? Do you count on that?
So our second deal, we did not. And our third deal, which we have announced, we did. It was also part of the Monroe portfolio. I would tell you that what it does for you is it gives you a jump on the due diligence at the end of the day, and so it makes you have a better ability to conduct that diligence and to know the company, and what you're getting into. And so I don't think it's it's helpful. We spend a lot of time at Monroe Capital focused on particular sectors. Technology is a big sector of where we invest our capital from a debt perspective at Monroe. And so when we go into a company at the SPAC level, where we co-sponsored the other SPACs as well, we have a deep bench of analysts. we have a deep bench of people with industry experience to do that diligence. So having that early on is certainly helpful. It gives you comfort. I mean, one of the things you're evaluating, I think it's important to evaluate in any deal, is the management team. So having years of experience with the management team is much different than just meeting a management team through a sell side process and having effectively limited time with that team as in any process versus having spent years getting to know them.
Yeah, so the questions are coming in. You're really interesting, Mark. So let me continue on this. So with all the SPACs looking for targets, some may encounter hurdles with finding or obtaining PIPE investors. What are some key differentiators that PIPE investors are now looking as they evaluate the SPACs?
Well, PIPE investors they're valuation driven at the end of the day. So like any investor, they're looking at what is going to be the return in making that investment. And so what's
the range? What are they looking at as far as, what the ROI needs to be? What are they targeting?
That's going to be on an individual basis. I couldn't answer that question concisely. Yeah. But they are looking to make a proper return on it's a risk-based return that they're looking for. And so most of these PIPEs are done at $10 a share. They're done in common stock. And so they're looking at they're committing money. A PIPE investor is committing money that they may not be able to put to work for 6 months. So they typically are coming in right when a deal is announced, before the S4 is filed, and therefore they have to wait for the entire process to be completed until they actually invest their capital. So that their capital is tied up contractually until that deal gets closed. But they're looking at, again, that it's an investment for them, and yep. Of course, they would hope it's a good investment.
Yeah. Okay. Great. Again, just running through these questions, they keep them coming. So it's a little bit of a sort of clarification, or someone's coming up to speed here. When you say that, unlike an IPO, the seller knows the price in advance, like it's pre-negotiated, right? Unlike an IPO, how does that play through as the sellers end up owning shares in the public company? So price is still ultimately subject to public reaction or how the stock trades.
That's a fair point, and it's a fair question. My comment is when you structure a deal, when a business combination is structured, there's a price that it is structured at, and the stock is bought at that price. Of course, it then goes public, and then it is subject to the valuation that the public market puts on it. But sometimes there's other aspects of it that are important for having that pricing that are locked in on that day one of closing.
Here's a question, a little bit referring to some of my opening remarks. So one of the advantages of listing the SPAC was certainty in the valuation, right? So there's the negotiated value. So uncertainty of closing in the PIPE, if required, the shareholder can redeem even after approving the deal. How would you, this is a complicated question, how would you structure the SPAC acquisition to avoid these pitfalls?
A shareholder can always, the SPAC is structured so a shareholder can always redeem his capital up until, I think, 3 days from closing is when they have to give notice. So there is, there's no way around. That's the structure of the SPAC. You do have the PIPE capital that gets committed on some of these deals, which is make sure that capital is committed capital. It's there at closing. But I'm not sure if I'm answering that question. Yeah. That's a complicated one.
Yeah, it is, and it's by deal by deal. I had a statistic, or I heard a statistic that that redemptions were, the average redemption was 58%. Have you heard that, Mark? That it was that high? I don't know what
The numbers do keep changing. I mean, there's a broad range of redemption levels. My understanding is that the redemption levels have been going up recently, but I don't have the most data. I don't have the best data on what percentage those redemptions are right now.
Right. Well, it sounds fairly high. It sounds like your repay one, you didn't have too many redemptions, right?
Repay was a strong deal.
Yeah. As can be seen, you could still have a strong deal and the stock still trades below 10, and just from an economic decision, right? You just redeem your shares because just economically, it's that, unless you're a long-term holder, right?
Correct. I mean, you can always go and get your money back in trust. So typically $10 a share. So that is available, but you're looking towards that appreciation if you stay with the deal.
Yeah. We still have lots of questions, so thank you for the question. I want to get to all of them. Mark, you're a very popular guy. Okay. Is the cost of listing through a SPAC cheaper or costlier than a direct IPO listing? I don't know if you've done any directs. Is this something that you can?
We haven't done any of the direct to IPO. I know that's a hot topic right now. There's a lot of different costs that go into these deals that one can evaluate, and it really is deal by deal specific in terms of trying to figure it out. There's valuation differences that potentially go into it as well. So I think it's not a simple answer. It's a more complicated formula as you try to figure out the answer to that.
Yeah. Okay. Following up on the topic of due diligence, has the importance of conducting personal background checks on management team of a target group company grown since the pandemic with less in-person meetings? This is interesting. I mean, how are you conducting your diligence meetings, right? Is it all through Zoom? Are you flying around now? I mean, this is a general M&A question, but that'd be interesting to hear how you've
I think we're like any other buyer at the end of the day. We're open to conducting in-person meetings. Most of the meetings are through Zoom. I think everyone has seen that it's been a very efficient method to actually conduct deals, particularly as a SPAC. There's a lot of meetings that we have. There's meetings with lots of different investors, and then there's meetings with lots of different companies. And just as a deal professional in general, instead of me spending so much time on a plane going from meeting to meeting and all that time that gets wasted, we can look at a lot more deals, and we can be more efficient through the process. Now, you certainly miss something not having the in-person meeting, but for us, a number of the companies that we're able to look at, we had met the management and knew the management before.
Yeah. Okay, great. Let's wrap up with this question. I think this is first, your viewpoint on what the future will be as well. So how do you see the SPAC structure maturing over time? For example, we've seen this structure go from a very heavy sponsor dilution via warrants to structures with rights instead of warrants, and lower dilution, and solely founder shares or 3-year lockups, et cetera. So where do you think that, how do you think that's going to mature over time?
I think it's going to be sponsor dependent at the end of the day. I think you're going to see repeat sponsors continue to be successful and be able to drive a strong deal. And then I think you're going to see there's always going to be continual new sponsors, new SPACs that want to go out there, and likely they're going to have a more difficult time structuring a deal. So you could end up, and we have seen this certainly, a bifurcation in structures in the market. And I don't think there's one size fits all. I think you're going to see more diversification into different structures based on the quality of the sponsor. But you're going to see a lot more variety coming up than you have in the past.
Great, thanks, and we'll leave it there, Mark. This was very interesting, and thanks for your insights. And you certainly have an impressive background with the SPACs that you've worked on, and I want to thank all the participants who have submitted their questions. Hopefully, we answered maybe pretty much all of them. So with the section of few, if you answered more than one question, I only chose your one question. But Mark, thank you very much. Any parting words?
No, I just appreciate you having me. So thank you, Roger, and I'm looking forward to watching the rest of this.
Okay.